Good morning or afternoon, whenever you may be watching this video. Joel Seach, Principal Advisor, Harpel Financial Group. Hope you're keeping well and hopefully enjoying a bit of return to normality as we close in on the winter months. Just a quick update following the RBA's decision, the Reserve Bank of Australia's decision to raise interest rates yesterday, and how that impacts your overall situation, just generally speaking, in terms of markets, investments, shares, property, loans. So the RBA's decision to raise the interest rates by 25 basis points up from 10 basis points, brings it to 35 basis points, was brought forward due to increased pressures on inflation. The past few months, we've seen cost of goods, supplies and inputs increase dramatically, just due to a range of different factors. Very low interest rates has caused people's spending to increase. And a big part of it is due to supply chain shortages, which means, situations like Russia and Ukraine, there's those certain countries, big exporters of certain goods, wheat, for example. There's issues in getting those things, and restrictions placed on Russia, for example, has then caused supply chain issues and pressures to go upwards on other suppliers of those materials. And also China is another one. If you've seen the images of the port recently in China, there's a lot of ships, cargo ships, held up there because of China's continued lockdowns with the coronavirus that they're experiencing. They haven't changed their mantra around that. So there's been some lockdown of their situation, and then the port has then clogged up in terms of being able to get cargo ships in and out, and that then causes supply chain issues. The other pressures we've had, obviously, has been the lack of internal migration, or lack of foreign workers coming in, or visa workers coming in, which has then caused pressure on jobs and input costs. The barista making $30 an hour has now gone to $35 or $40 an hour, which then feeds into the input costs that we see overall in your day-to-day shopping. And even noted from some of the big supermarkets, Coles, for example, have said inflationary pressures will be feeding through to the shelves as well. So inflation is all around us, and it has a large part to play in everyone's lives, from a cost of buying things and to a cost of, to an investment return as well. So what we expect to see happen over the coming 12 months or so is we'll see some more rate rises. Yes, the RBA raised the rates before an election, which is interesting because the politicians will always preach that they're, during their time in government, whether it be either side of the party, say that interest rates were at a certain level or low, but the RBA is independent to politicians and political parties. They're their own area, so they'll raise rates on their data that they get coming through, irrespective of what's going on. But it is unusual to have a pre-election rate rise. I think well needed, and we're coming off really low bases, so definitely well needed. They'll only raise rates as far as necessary to try to cool inflation. They don't like inflation to sort of really ramp up, and once inflation does get up too high and stays there, it is hard to bring it back in. And you would have heard the quote that bringing the genie back in the bottle, bringing inflation back in the bottle. So while it's transitory, shorter, sharper rate rises to try to bring that in is more appropriate, and it will help definitely try to cool that area. Because we don't want to see inflation run away. We don't want to see the cost of goods run away. A certain amount of inflation, 2 to 3% is the band they tend to go for, is what they want to try to aim at. Right now, I think for the year, it's about 5.1, which is still a lot less than some of the countries in the US and Europe. But yeah, they don't want to see it run away. And the rate hikes aren't unlikely to derail the economic recovery. They don't want to see that. The RBA doesn't want to see the recovery that we're needing to have after the last couple of years. They want the recovery to be held within a bandwidth, and they want that to be consistent recovery, and they don't want to stymie that either. So they're not going to jeopardize that recovery by really ramping up rates to a dramatic level. And eventually it's at 35 basis points now. We might see it get between 1.5% to 2% by the end of next year, which is still very, very low from a long-term perspective. And we wouldn't expect the long-term perspective of rates to be up where they were back in the 90s or even the 2000s to an extent, because it's a different era now. There's higher debt levels, lesser unemployment. and higher wages growth, which we expect to continue to see as well. So we don't believe we'll see the interest rates go up like they used to be. And it's the first rate hike we've had since 2010. So that was the last rate hike we've had, or they're called tightening, monetary tightening. So that's the last rate hike we've had. Unemployment, as I mentioned before, is about 4%, slightly just under that, but they rounded up to 4%. And they're expecting that to be potentially a 3.5% by next year. And inflation, they still expect inflation to go up in the short term to around 6% to year end. And they actually expected it to be only 3.25 at the start of the year's end. So it's increased a lot. But the rate hikes will help slow that down, and mainly due to having, consumers having less money in their pocket to spend. Because if consumers have, say, any kind of debt levels, it's going to increase those variable rates a little bit more, and they'll feel the pinch a bit. Fixed rates won't move until the fixed rates are due for anyone with a loan, anyone with debt outstanding. It'll add to the cost of living pressures a little bit, which will help subdue inflation to an extent, because there'll be less money floating around, or less money that's discretionary spending to float around and push into the cost of goods. Non-discretionary spending will still be there. So in terms of how that impacts share prices and portfolios, interest rates are still substantially low, and the share market's factoring in these rate hikes. And rate hikes are a sign of a recovering and a strengthening economy, so they're not necessarily a bad thing. And stocks, depending on which stock you have, stocks more broadly will perform okay depending on what area they're in. So, for example, banks have done well because banks will increase their rates and they'll increase their margins, and they'll pass on the full margin to borrowers, but they won't pass on the full to deposit makers, people with term deposits. And then some areas won't do as well, that aren't the price makers, they're kind of the price takers. So, there's going to be different areas of shares. So that's where it's important to have that diversified portfolio. And property, to an extent, property is really hard to generalize, because property is so different in different areas. Some areas will still perform quite well, and then some areas will come off the boil a little bit. But interest rates for property is only one lever. There's so many different things that go into property. So it's hard to generalize property, but they do want to cool the market a touch, because it has run quite rampant the last couple of years with this situation. So they're hoping to try to cool the market a little bit and slow it down a touch. But borrowers, when you're doing borrowing, they factor in these substantial rate increases to sort of make sure the viability is there for people to be able to borrow that amount and repay it. So people had that cushion in there already, and people have saved a lot. There's a lot of money and information outstanding of money that is sitting in offset or redraw. So people, consumers are smart to an extent, and they have, expected these rate rises to come because they have been so dramatically low. In summary, what we'll see is these rate hikes begin to unfold, and we'll see a few of them coming up, most likely another one in June, and then we'll see how the year unfolds there, probably another one or two. And the aim is to try to slow down that inflation and keep those costs of goods measures and just the cost in general at a decent level. They can't control supply chain, which is the issues we see with the ports and things getting clogged up and countries in in political war. But they can help kind of control that consumer spending to an extent as well. So hopefully this market update's been a bit longer than normal, but there's a bit to unpack with it, 9 minutes in total. Hopefully it's been informative to you and helps you kind of understand the correlation between RBA rate hikes and how inflation works in the day-to-day measure, and an overall in the investment markets, whether it be property and shares, and how that impacts more broadly. Any questions, don't hesitate to reach out as always. And we look forward to catching up with you in due course as we go through our review periods. Joel Seach, Principal Advisor, Harpel Financial Group. Have a great day. Bye now.